Welcome to our property market commentary for May 2019, where Dr. Andrew Wilson and I are going to give you an update on what's happening in our property markets. And to join me to give expert commentary on our economy, our property markets, I've got Dr. Andrew Wilson, Australia's leading housing economist, chief economist for myhousingmarket.com.au. Welcome, Andrew.
Thank you, Michael.
Now, we've had another interesting month in property. We always seem to have an interesting month.
Well, that's true.
But I want you to share the latest data with us. But I want to put you on notice, Andrew, because I noticed something as I read the minutes from the Reserve Bank, their commentary, and I think it's going to give us a clue as to what's going to happen to interest rates and why. So I'd like to have your thoughts on what I see as a major change. But before that, to understand our property markets, they're not working in isolation. They're working as part of a global economy. So let's start with the macro view first. What's happening in the world economy, and then we'll drill down to Australia. To me, it looks like our global economy remains reasonable, but there seem to be risks around, and there are three major areas: Europe, Southeast Asia and America. So let's start with the United States. What's happening over there, Andrew?
Well, look, this conundrum that's affected most advanced economies since the GFC, one of low interest rates, record low interest rates, have failed to ignite inflation and wages growth, but we've had very strong labour markets. So the big three haven't really been working together as they usually do. That's prices, incomes and jobs. We're starting to see maybe an early signs after all this time that incomes growth is starting to pick up in the US, only slightly at the moment, but the trend is certainly upwards. Latest US GDP numbers were very strong. There's no doubt that the US economy is still growing at a robust level. Sideways movement, I guess, at best in the Eurozone. And there are certainly rising concerns over the performance of China. And I think that there are also, again, issues over trade between the US and China. There looks to be what was a peaceful outcome to those tariff discussions now looks to be questionable. And this, of course, will work its way into more uncertainty in our global economy, given the strength of both the Chinese and the US economies.
Well, great. Let's look at the Australian economy. How's it performing? Clearly, it's not in as good shape as the Reserve Bank would like it to be.
Well, look, we've other than the latest data, obviously, was very poor in relation to inflation. The targeting of the Reserve Bank of inflation, that 2 to 3% target has failed to be reached for a number of years now. I'm not a big target person. I think economists are constrained by these rule books that they create. There needs to be an understanding that economics has a dynamic to it. It does change, and we shouldn't be transfixed into particular targets that only create imbalances going forward. But there's no doubt that inflation is obviously very low at the moment. And this, of course, is part of that conundrum that low interest rates haven't fueled prices growth and wages growth, despite having very strong labour markets. Typically, we're suffering that same issue. However, similar to the US, and we'll talk about this a little later in relation to interest rates, Michael, we're starting to see maybe some early signs of some wages pick up. Certainly, one swallow doesn't make a summer, and we'd need to see a concerted period of data to perhaps get some hope that we're moving back into what we'd expect from a growth cycle that is higher incomes and higher inflation.
Andrew, what's happening with employment? I see the figures probably weren't as strong as the Reserve Bank would have liked.
Generally, our unemployment rate is still at a 5-year low, at around about that 5% level. I think that there is some upside there. The other point perhaps that we need to mention is that migration numbers are also now being trimmed, although they will remain reasonably strong. That migration was fueling jobs growth, but you never know, there might be another end to that particular pineapple with less competition for jobs from migrants, perhaps putting upward pressure on incomes. But certainly I think that the Reserve Bank perhaps is recognising that we're likely at the peak of our unemployment rate in terms of its low, and in terms of jobs growth as well, in terms of their high.
One of the leading indicators to me is credit growth, and that's been annualised at 4% at the moment, and that's the lowest on record. How do you see that?
Well, why are we surprised? We've had these highly questionable policies from the financial regulator constraining investor activity. We've got very low numbers of investors in the marketplace now, and that's worked its way into lower prices, which then's worked its way into a decline in confidence from buyers and sellers generally. And we're seeing very low turnover of property, and of course credit growth overall is low as well. You know, it's quite confounding that the whole premise of hit on investor activity from APRA was to avoid exactly what it's achieved, and it was all about the risk of higher interest rates. And I think if we do get a cut in interest rates, which certainly still seems reasonably likely, that really does blow that policy of restricting investor activity out of the water as being completely against what the forecast was supposed to bring. Higher rates. In fact, it's going to bring lower rates, which means that, it's the old story, beware of the law of unintended consequences and don't interfere in housing markets.
Well, the Reserve Bank didn't interfere this month. It kept the interest rates on hold for the 34th consecutive month.
Yes.
I want to come back to that later on after we go to the housing data, but I think it's worth having a look at some of the figures that you've done your data to show us what's happening in our housing markets, because as you already hinted a couple of times, it sounds like some green shoots could be appearing and the rate of decline in our housing markets are easing, Andrew. So let's start with the auction data. Auctions are clearly not as prominent a way of selling property today, but they still give us an underlying trend, the pulse of what's happening in the market. So what are you finding in the auction data, Andrew?
Well, look, as you suggested, Michael, the auction market is a reasonably accurate leading indicator of what's happening generally in housing markets, particularly in Sydney and Melbourne, where there's a higher proportion of auction activity than the smaller capitals. But even the Canberra and Adelaide market, what happens in that auction market, those auction markets can be a reliable indicator of overall activity. And we've just obviously come through April. The April data was infected heavily, naturally, by what is always the holiday distractions of April. Overall, the trends were quite clear and are now starting to become, reinforced, particularly in the Sydney and Melbourne auction markets, Michael. Melbourne market is now starting to trend up. Its clearance rates are now heading above 60%. Sydney has held above 60% for most of the past couple of months. And that's quite a reasonable outcome. Definitely the trend is now moving upwards in terms of buyer activity and clearance rates in those two bigger markets. And I think that that's a good sign, as you suggested, of perhaps a revival of confidence, as I said, particularly from buyers in the marketplace. Now, the other end to that is how are sellers going? Now, there's no doubt that it's a very quiet market for seller activity. Sellers are still quite fearful of engaging the marketplace. I think that's going to need a sustained period of clearance rates above 60% to get sellers back into the marketplace. I think that the platform is being built for that, and I think that we're likely to see a better spring coming forward, particularly given how the spring fell away sharply last year, as long as we see a sustaining of those 60% clearance rates. But volumes are well down, Michael. Turnover overall is well down compared to a year ago.
Well, some people are going to say, oh, that's only a small segment of the market. Others are going to say agents don't report all the auction results, and others are going to say, well, they get revised up or down. The thing is, it's the trends that I think are more important, Andrew, than the individual figures. So the trends are what's pointing in the right direction. We started this year being concerned that the auction clearance rates were dropping week after week last year, 2018. So it's heading in the right direction. What has this meant for price growth?
Well, we can see if we look at the year-on-year comparisons, particularly the two big markets, that yes, prices are down. And those auction price numbers tend to reflect what's happening broadly with house prices in Sydney and Melbourne. And we can see that numbers are down year on year, April compared to April last year, but not by a lot. It's only incremental at the moment. And I think a lot of that is because we're seeing a higher proportion of higher priced properties, particularly in the Sydney market, being sold. And that, of course, means that when you're doing your comparisons, we've got to understand that a house price methodology can be problematic because of the mix of properties from period to period. If we get a higher proportion of lower priced properties compared to a previous period, that obviously puts downward pressure on price models, and the reverse, if we get a higher proportion of higher priced properties, that puts upward pressure on house prices. And if we look at the big capitals, that sort of reinforces, I guess, what the auction market has been telling us. We have the Sydney market down, overall median price down 1.5% over April compared to March. Melbourne down 1.6% over April compared to March, and Brisbane up just 0.5% over the month. But again, we've got to reinforce these are raw numbers and they're not adjusted for property mix, for change in mix. But again, they're only slight changes, reasonably slight changes over the month. And that's what other price models are signalling, that there's still downward pressure on prices. But the trend now seems to be levelling out, with the price declines not as steep as they were earlier in the year, and particularly, of course, last year.
Well, interestingly, there are markets within markets, geographic, different types of properties, different price points. And I know each weekend you get out the most comprehensive data of auction clearance results, and then you break it down to different regions, and that's published on your LinkedIn and Facebook, but also on Property Update each week. And interestingly, it varies considerably from one region to another within the state, doesn't it?
Well, it does, Michael. And if we look at the breakdowns for the Melbourne market, we can see that the Outer East has been a particularly strong performer over April. The Melbourne market tends to have more of an even spread when we look at regional results. There's not a lot of difference between the highs and the lows in terms of clearance rate activity. When we look at the Sydney market in terms of its regional performances, there's no doubt that the lower North Shore has been the strength of the market. Inner suburban higher priced properties continue to find buyers in Sydney. Clearance rates quite robust in those areas, despite low numbers of properties being offered. But the further out we go in Sydney, Michael, the lower the clearance rates, and volumes are quite low. Certainly these clearance rates will act to increase confidence from sellers, which are certainly still the missing link in our housing markets, and perhaps set the scene for a revival in spring.
Andrew, you're going to disappoint some people, because the doomsayers who are expecting the markets to collapse are going to be disappointed what you've reported. The other thing is, there isn't really evidence of a lot of forced sales, and that's why, in my mind, we're really having a soft landing. Yes, prices are still falling and going to fall, but there is a bottom underneath it, because there aren't forced sales, are there?
Well, it's not, Michael, and this is something we'll talk about later, and that's the apartment market is really not seeing, despite very strong, obviously, stock numbers, properties on the market, we're not seeing forced sales from developers in the apartment market. And this is something that's, again, putting a floor under price declines with the apartment market or the unit market. And we look at clearance rates and prices from the auction market, units versus houses. Units continue to outperform houses. I think this is a sign of the times, and we're not seeing that fire sale environment, particularly in the apartment market. And talking about the doomsayers, Michael, we've had a lot of predictions this year about the level of price declines that markets, particularly Sydney and Melbourne, will experience. And even though prices, yes, will be lower at the end of this year than they were at the beginning of the year or the end of last year, I think that we can be maybe a little bit more optimistic that price declines will, in both those Sydney and Melbourne markets, will be under 10% as the year unfolds.
Okay, let's look at the other side of the coin, the vacancy rates and rental trends. Yeah. What's happening around Australia, Andrew?
Well, we certainly have some interesting trends in terms of the rental market, Michael. We've got to understand that we have some issues that are driving rental market, particularly vacancy rates in the bigger cities. And that is, of course, we've seen a surge in first home buyers, courtesy particularly in Victoria and New South Wales of those changes to stamp duty that came into effect 2 years ago. And that's acted to take demand away from the rental market in Melbourne and Sydney. And of course, we've seen a lot of apartments coming into the market as well. So we've seen decreased demand and increased supply. And that's certainly been evident in the Sydney market. Vacancy rates, get my rates right, Vacancy rates in Sydney have climbed over the past year and are now tracking at around about 3%. And, we're starting to see a little bit of an increase in vacancy rates as well in the Melbourne market. But overall, the smaller markets remain quite tight for vacancy rates, with the exception of Darwin. We're seeing that translate itself into rental outcomes. Sydney rents are down over 7% now over the year. That's no surprise. Once we start getting vacancy rates around 3% or over 2.5% to 3%, that does put downward pressure on rents. We're seeing that now in Sydney. We're seeing strong growth in rents reflected in those markets that have low or tight vacancy rates, particularly the Canberra market, where rental growth is very strong.
Now, Andrew, I hinted at the beginning there's something I'd like to ask you about the Reserve Bank. Having read their minutes, they signalled that they could cut interest rates if the jobless rate does not fall below its current rate of 5%. Reserve Bank Governor Lowe said further improvement of the labour market was needed to push inflation back to where the central bank's range was, the 2 to 3% target. But Andrew, doesn't this represent a change from previously where they thought unemployment would have to rise before interest rates were cut?
I'm bemused at a lot of the conversation that's gone on in regard to inflation that seems to miss the point, which is not that, I guess, difficult to comprehend, or it shouldn't be, from those that are making statements in regard to low inflation, meaning lower interest rates. We need higher incomes, and it's low incomes that will get the Reserve Bank to act. And of course, it too is maybe putting the cart before the horse, saying, well, we're looking at jobs, and if jobs don't improve, well, we'll cut rates. Well, incomes come first, and then jobs in terms of that equation.
Okay, so thank you for giving us that summary of what's happening around the Australian markets. There are so many other things we could have discussed, and we are going to continue to discuss weekly in these Property Insider videos. So we'll catch up again this time next week to have another chat. Thank you very much, Dr. Andrew Wilson. Speak to you soon.
Thank you so much, Michael.